Hi, welcome to Integrated Planning, where we take an integrated approach to growing and protecting your wealth. My name is Sophie Blay, and I'm here to share some information with you about RRSPs versus TFSAs. RRSPs are Registered Retirement Savings Plan, commonly known as RRSPs, tax-free savings accounts, commonly known as TFSAs. One of the number one questions we get asked as planners is, what are they, what are the differences, and when should I be using them? And there isn't a one-size-fits-all answer to RRSPs and TFSAs, and it is very dependent on your particular planning situation. But I would like to provide some general information on both RRSPs and TFSAs and when either or might be a good idea for you to use. So let's start with RRSPs. RRSPs were introduced in 1957 by the federal government to encourage Canadians to save. They were noticing that Canadians weren't saving enough and pensions were starting to go more to the wayside, and they were worried that the Canadian population wouldn't be prepared for retirement. RRSPs really took off probably in the 1970s and the 1980s in a more robust fashion. And really what you can do with an RRSP is you're able to save a certain percentage of your income in a tax-deferred vehicle. You can start investing in an RRSP when you turn 18, and the one criteria to earn eligible RRSP room is that you're earning T4 income. Many people will ask, what types of investments can I put in my RRSP? You can pretty much put any type of investment within an RRSP as long as it's deemed RRSP eligible. So for example, mutual funds, hedge funds, individual stocks, GICs, pretty much anything that you would invest in outside of an RRSP can be invested in within an RRSP. So RRSPs are a tax deferral tool. So you don't avoid tax entirely, but you certainly have the opportunity to defer it. With an RRSP, it's pretty simple. When you put money into your RRSP, you reduce your annual taxable income. If you take money out of your RRSP, you increase your taxable income because that's considered income. The goal with RRSPs is to take income that you earn in high tax years and move that to a low tax year. So ideally, most people believe that when they're in retirement, that their income will be lower. So that's a great place to defer RRSP income to. So an RRSP can be a double-edged sword. If you take out income in a high earning year, you could end up paying additional tax more than you expected to. So that's why it's really important to work with your integrated planning team, your accountant and your advisor to balance out what you're saving versus what you're taking out. So normally when you withdraw income from an RRSP, you're taxed on that income. There are two situations where that is not the case. The first is the home buyer's plan, where you're able to withdraw a portion of your RRSP to put towards a down payment on a home. It used to be that you could only use this benefit once. There are actually now some new considerations, and people can actually access RRSP money to buy a home a second or even a third time. Please see the CRA website to get further details. The second opportunity you have to withdraw money from your RRSP without being penalized is the lifelong learning plan, where you can withdraw up to $10,000, at least currently, to put towards approved education expenses. It's important to note with the home buyer plan that you do have to repay what you've withdrawn over 15 years. So you do have to pay it back. And when you put that money back into your RRSP, you don't get the subsequent tax break. So that's important to understand. Same holds true with the lifelong learning program. You can put that money back into your RRSP, but again, you do not receive the subsequent tax deduction. If you'd like to learn more about either of these programs or any of these programs, please make sure you're talking to your professional advisor, your financial planner, your accountant. They'll be able to help you navigate the programs and see if they'll work for you. So one of the reasons I like RRSPs, especially with younger clients or clients who are having a hard time saving, it is a bit like a forced savings plan. Because of some of the penalties that exist if you take that money out early, people tend to be more committed to investing in their RRSP and not touching that money. So if you're somebody that needs that little extra push to stay invested, the RRSP might be a good choice for you. So a simple summary of how RRSPs work. When you invest in an RRSP, it lowers your taxable income. Any growth within the investments within your RRSP grow tax-free until they are withdrawn, at which time they are subject to your marginal tax rate. So it's important to understand that that tax-deferred growth can make a huge difference over a long period of time to your savings. So TFSAs were introduced in 2009 as another savings opportunity for Canadians. TFSAs work differently than RRSPs in that when you invest in a TFSA, you do not decrease your taxable income, but the investments within the tax-free savings account grow tax-free and are not subject to tax upon withdrawal. So that's probably the biggest difference between an RRSP and a TFSA. Just like an RRSP, you can invest in multiple different types of investment vehicles within your tax-free savings account. And there are a variety of different objectives or planning considerations as to what you might put in a TFSA. Oftentimes in planning, we'll talk about using the TFSA for shorter term planning objectives. So let's say, for example, you're saving to buy a new home, or you're saving to buy a large purchase item, or you're just really not sure when you might need access to the money, but you know it won't be at retirement, it'll be before then. TFSAs are also often considered more flexible than an RRSP because you can put money in, you can take that money out, and then if you want to replenish the money that you've withdrawn, you can within a certain period of time do so. So that's in contrast to an RRSP. An RRSP, when you withdraw income, that room is gone. So any future contributions are considered new room within an RRSP. With both plans, you have an annual contribution limit that you're subject to. So the way contribution limits work with an RRSP and TFSA are as such. So for an RRSP, you are allowed to contribute a percentage of your income subject to a maximum outlined by the federal government. On your TFSA, the government has set an annual limit that you can contribute to a TFSA, and that has no bearing to how much you earn. Great news on both accounts. If you don't use the room in a given year, that room carries forward and you're able to catch up and contribute in subsequent years. Planning consideration for business owners. Business owners have the ability to invest in the TFSAs subject to the outline limits and maximums outlined by the federal government. As it pertains to RRSPs, you do have to have unearned income or be taking a salary in order to create RRSP room. As a business owner, if your income is being derived by dividends, those dividends do not create RRSP room. So you're approaching retirement. One of the common questions we get from business owners and individuals is what income should I be taking prior to some of the federal programs kicking in? Like the Canadian Pension Plan, Old Age Security, things like that. It's really important that you work with your integrated planning team, the financial planner, your tax accountant, to see what makes the most sense for you. Obviously, again, tax-free income comes out tax-free, and anything that you pull from your retirement savings plan will be taxed. It's really important to look at all of your income sources, the tax implications to all of those various income sources, and come up with a plan that best meets your needs and manages tax along the way. Another planning consideration as it pertains to RRSPs and TFSAs is group RRSPs matching plans as well as group pension plans. I never want to leave money on the table, and neither should you. At the end of the day, if your employer or your association is providing matching on RRSPs, is providing a pension plan, you should definitely take advantage of that. So which account should I withdraw money from if I have a need for cash? So there's a couple of ways to look at this, and again, I would always recommend that you talk to your integrated planning team and make sure that the answer to the question is the right one for you, but there are some simple suggestions. If you are looking to put a down payment on a house, let's say, you can access the RRSP homebuyer plan if you're eligible and meet the criteria. That's a great place to draw money from. If you are not eligible and you've built up a substantial little nest egg in your TFSA, you may want to use that. Another area where you may want to use the TFSA is for general purchase of a vehicle or different things like that, because there is no tax implication to withdrawing money from your TFSA. One of the other common planning questions that we asked is, do you take CPP early? Or do you withdraw money from your RRSP and defer, your CPP to a later date? There are a variety of schools of thought as to what makes the most sense, but it is always important to run through the numbers and to look at the implication to your particular situation with your planner. So to wrap it up, RRSP or TFSA, which is better? They're both great. They both have a really important place in financial planning. If you have a high income and you're looking for a bit of a tax deduction, RRSP is where you'd want to go. If you're looking at tax-free withdrawals later on down the line, the TFSA might be it. One of the common strategies that we use is actually investing in an RRSP and using the tax deduction to put into a TFSA. Another thing to keep in mind is you can invest in both. You don't have to choose one over the other, and one might be better one year than the other. So working with that integrated planning team, making sure that the decisions that you're making are in line with your financial objectives will get you the best results. If you enjoyed what you heard and you learned something new, feel free to press like or subscribe to our channel so that you can continue to get great updates on financial planning. Click the link below if you'd like access to some of our free resources to help you in your financial planning journey. Make sure you reach out to your financial advisor or CPA to make sure you have the right A-team behind you to reach your business and personal goals.